now your gateway to financial empowerment and prosperity. We dive deep into the world of finance, law, and strategic wealth management.
Now that you know how to access and review your credit report, the next chapter will cover building and improving your credit score. Here, you'll find practical strategies to boost your score over time, so you're in the best position for major financial moves like buying a home or car or accessing business financing, or be able to qualify for some jobs. Here's Chapter 3, Building and Improving Your Credit Score for the Credit Building Essentials Kit. This chapter guides you through actionable steps to actively improve, setting you on a path toward qualifying for loans and better financial opportunities. Chapter 3, Building and Improving Your Credit Score. Why building your credit score is worth the effort. Improving your credit score doesn't just help you qualify for loans, it also makes life more affordable. Higher credit scores lead to better interest rates, saving you thousands over time. A higher score can also help with renting apartments, getting approved for credit cards, and even securing lower insurance premiums. Step 1. Establishing a positive payment history. Your payment history is the most critical part of your credit score, making up 35% of it. Here's how to ensure you're building a strong payment history. 1. Pay on time, every time. Even one missed payment can significantly hurt your score, so prioritize consistency. Set up automatic payments to avoid forgetting due dates. 2. Catch up on past due accounts. If you have any accounts that are past due, prioritize catching up on these first. Once caught up, maintain on-time payments moving forward to show lenders you're committed to improvement. 3. Consider payment reminders. Use tools like calendar reminders or personal finance apps to help you stay on top of all your bills. Quick win. Set up autopay or reminders for all your bills, so you're never late on a payment again. Lowering your credit utilization ratio. Credit utilization, or the amount of your available credit that you're using, makes up 30% of your credit score. The lower your utilization, the better it is for your score. Aim to keep it below 30% and ideally around 10%. 1. Pay down balances. Start by paying down credit card balances, beginning with the highest interest debt. Every payment that lowers your balance improves your credit utilization. 2. Request a credit limit increase. If you're in good standing with your credit card issuer, you may be able to request a limit increase. A higher limit with the same balance reduces your utilization ratio. 3. Spread out your balances. If you have multiple credit cards, consider transferring some balances to distribute the debt more evenly, which can lower the utilization on each card. Example: if you have a credit card with a $10,000 limit and a $3,000 balance, you're using 30%. Paying down even a small amount, like $500, can make a meaningful difference. Step 3. Build a long credit history. Credit history length makes up 15% of your score. The longer your accounts have been open, the better it is for your score. 1. Keep older accounts open. Resist the urge to close old credit card accounts, even if you don't use them often. Closing them reduces the average age of your credit and may lower your score. 2. Use inactive accounts occasionally. Make a small purchase on older cards every few months and pay them off in full. This keeps the account active and benefits your score. Tip: only close an account if it's absolutely necessary, like avoiding high annual fees. Otherwise, it's best to leave it open and use it occasionally. Step 4. Minimizing new credit inquiries. Every time you apply for new credit, a hard inquiry is added to your report, and it can slightly lower your score. Although this impact is temporary, too many inquiries in a short period can make you look like a risk to lenders. 1. Limit new credit applications. Only apply for credit when it's absolutely necessary. Each hard inquiry can affect your score, so aim to space out applications over time. 2. Pre-qualify. When possible. Many credit card companies offer pre-qualification checks that don't affect your score. Use these to gauge your chances before applying. 3. Focus on growing existing accounts. Instead of opening new credit accounts, work on building positive history with your existing accounts to improve your score. Step 5. Create a healthy mix of credit. Having a mix of credit types, e.g., credit cards, installment loans like car loans or student loans, and mortgages, can positively impact your score. However, this makes up only 10% of your score, so it's not worth opening new accounts solely for credit mix. 1. Diversify when it makes sense. If you're considering a loan for a legitimate purpose, like a car loan or mortgage, having different types of credit can be beneficial. 2. Avoid unnecessary debt. Don't take on new debt purely to diversify. Your score will benefit more from paying down existing balances and focusing on on-time payments. Example: if you already have credit cards, opening a small personal loan may add diversity, but only do so if it aligns with your financial goals. Quick tips for maintaining and growing your credit score. 1. Monitor your score. Regularly tracking your score helps you understand what actions are working. Use free monitoring services or apps to check your score monthly. 2. Dispute any errors. As covered in the previous chapter, regularly review your credit report for inaccuracies. Any mistake that unfairly lowers your score should be disputed right away. 3. Use balance alerts. Many banks offer balance alerts that notify you if you're close to a certain spending limit, helping you keep your utilization low. Next step. With a solid foundation and an action plan in place, the next chapter will cover tools and resources for credit success. We'll explore apps, budgeting tools, and other resources to help you keep building your credit effortlessly. Here's Chapter 4, Tools and Resources for Credit Success, designed to give you a toolkit of apps, budgeting resources, and AI tools to help them streamline and maintain your credit-building journey. Objective: introduce you to useful tools and resources that simplify credit building, from budgeting apps to credit monitoring services. Stay on top of your credit journey without added stress. Why tools and resources matter. Building and maintaining a strong credit profile requires consistent effort. By using the right tools, you can automate parts of the process, track your progress easily, and receive alerts for any changes or issues on your credit report. This chapter focuses on empowering you to succeed without having to micromanage every detail. 1. Budgeting apps. Managing your money. Easily. Budgeting is one of the most powerful tools in your financial toolkit. When you manage your finances effectively, you can keep credit utilization low, pay bills on time, and avoid debt. Here are some top budgeting apps that help you stay organized and on top of your finances. Mint Cost, Free Best for overall budgeting and financial tracking. Key features: Mint automatically categorizes transactions, tracks spending, and provides alerts for bill payments and overspending. It also offers insights into your credit score. WhenAb, You Need a Budget. Cost $14.99 month, 34-day free trial. Best for hands-on budgeters who want to take full control. Key features: YNAB helps you allocate every dollar and encourages saving. Its interface is highly focused on goal setting, which can be helpful if you're trying to pay off debt or save. Pocket Guard Cost, free with in-app purchases. Best for monitoring spendable income. Key features: Pocket Guard shows you what's left to spend after bills, goals, and essentials are covered, helping you avoid overspending. Tip: choose the budgeting app that best suits your style and stick to it. Regular budgeting helps you keep debt under control, which is crucial for a healthy credit score. 2. Credit monitoring services. Keeping an eye on your score. Monitoring your credit regularly allows you to catch changes and potential errors quickly. Here are some reliable credit monitoring services. Credit Karma Cost, Free Best for simple score tracking and monitoring for beginners. Key features: Credit Karma provides access to scores from TransUnion and Equifax, offers credit advice, and tracks score changes over time. Experian Cost, Free Basic Plan, premium options from $9.99 month best. For detailed monitoring and Experian-specific reporting. Key features: Experian offers free access to your Experian score, plus personalized recommendations to improve your score. Their paid plans include alerts for changes on all 3 bureaus. MyFICO Cost, plans start at $19.95 month best for comprehensive credit tracking, including FICO scores used by lenders. Key features: My FICO provides access to various FICO scores and has alerts for changes to any part of your credit profile, including new accounts and hard inquiries. Tip: pick one credit monitoring service to track your score monthly. Consistent monitoring can protect you from identity theft and catch errors quickly. 3. Payment reminders and bill management. Automating bill payments and setting reminders for due dates is key to maintaining an excellent payment history. Here are some effective tools for managing your bills. Prism Cost, free best. For all-in-one bill tracking. Key features: Prism aggregates all your bills in one place and sends reminders. You can also pay bills directly from the app, making it easy to stay on schedule. A simple bank's goal. Feature cost, free with a simple bank account. Best for people who prefer saving for specific goals directly within their bank. Key features: Simple Bank allows you to set goals and automate saving toward them. Its Safe to Spend feature also keeps you from dipping into goal funds for daily expenses. Calendar app reminders cost free best for simple and customizable reminders. Key features: Use your smartphone calendar to set monthly reminders a few days before each bill is due. This is especially useful for clients who prefer minimal apps. Tip: Automate payments when possible and use reminders for anything not automated. This reduces the risk of missing payments, which can hurt your credit. 4. Credit Builder Loans. Building credit while saving. A credit builder loan is designed specifically to help people with low or no credit history build credit. Here are 2 good options. Self, formerly self-lender. Cost. Plans start around $25 month best. For people just starting to build credit. Key features: Self holds the loan amount in a secured account while you make monthly payments. After completion, you receive the money back minus interest. Payments are reported to all 3 credit bureaus. As credit unions, cost varies by institution, best for people comfortable working with local banks or credit unions. Key features: Many credit unions offer credit builder loans with lower fees and rates. Check with local institutions for specific options. Example: a $500 credit builder loan with Self can be paid off in a year, with monthly payments reported to the credit bureaus. This helps establish a positive payment history and increases your score. 5. Debt payoff. Calculators and tools. Paying down debt is crucial for reducing your credit utilization ratio. These tools help you strategize your debt payments effectively. Undebt. It cost, free best, for creating and tracking debt payoff plans. Key features: This tool lets you enter all your debts, choose a payoff strategy, like Snowball or Avalanche, and track your progress. And Savvy Debt Payoff Planner cost $2.99 month or $29.99 a year best for visualizing and planning debt payments. Key features: This app calculates interest savings based on your payoff plan and tracks your progress, which can be motivating. Google Sheets Debt Tracker cost free best for DIY budgeters who want a customizable solution. Key features: You can create your own debt tracking spreadsheet in Google Sheets, where you can enter each payment and track your remaining balances. Tip: Use a debt payoff calculator to see how quickly you can pay off debt with extra payments. Knowing the potential interest savings can motivate you to pay down balances faster. Putting it all together, your ultimate credit toolkit. By combining these tools, you'll create a powerful system to monitor, maintain, and grow your credit. Here's how they work together. 1. Start with a budgeting app. Track your expenses to avoid overspending and keep debt under control. 2. Use credit monitoring services. Regularly check your score and be alerted to any changes or errors. 3. Set up payment reminders. Ensure all bills are paid on time for a consistent, positive payment history. 4. Consider a credit builder loan. If you're new to credit, a credit builder loan can give you a positive boost. 5. Track debt payments. Use a debt payoff tool to manage credit utilization and see the impact of each payment. Key takeaways: Tools like budgeting apps, credit monitoring services, and payment reminders help you simplify credit building. Credit builder loans are useful for people new to credit as they build a positive payment history. A consistent monitoring, timely payments, and effective debt management are the core of a successful credit journey.
Thank you for tuning in to Generational Wealth Now, where we empower you with the knowledge to build a prosperous future. If you found this video valuable, don't forget to hit the subscribe button and turn on notifications for more insightful content. Have questions or need personalized advice? Feel free to reach out to us directly. Simple click on the link on bottom of this video. We are here to support you on your financial journey. Until next time, keep striving for greatness and creating a legacy of abundance.